All right, looks like we're back to Michael. Item 7, is that proceeding emerging managers and real estate reports?
Yeah, let me bring Michael up and have the consultants, Greg, Monica, and Michael come up as well. This was an important step for the board, especially the new members. We had adopted a long-term business plan to enhance diversity in the management of our investments. And we have a very robust program already in place. We've thankfully won some national awards. In that business plan, we addressed 4 key areas that we needed to work on. The first was advancing diversity in corporate boards, and we have done a tremendous amount of work there with CalPERS on the diverse director database in Ann Sheehan's area. The second pillar was to focus in on real estate. We have attempted to enhance diversity of real estate managers several times, all the way back to 2003. It has been a struggle, so what we decided to do is back up. We hired Monica Montilla and asked Michael and the team together as 2 consultants and look at the real estate space and figure out how should we attack it. Our goal was to create a white paper, which is before you today. We want to publish that so it's out there for our peers as kind of a roadmap of here's how we think you got to do diversity in real estate. The challenge is, and you're going to hear from them, real estate, as you know, is a very local business. Every town has somebody who's specialized in office, or in our town, if you think about tilt-up warehouses, a name pops right in your head. But that isn't true if you got to Reno or if you went to Phoenix or all the way out in the East Coast. So they studied this area. They're going to present their findings to you. The next step, because that's what's important, is now that we've studied it, what are we going to do about it? The next step is for real estate to come back to you in the summertime and really develop an implementation plan of, okay, here's what the opportunity set is, but here's how CalSTRS is going to attack it. So and hopefully I'm not stealing your thunder and jumping ahead, but particularly on INV 624, the real estate staff will come back with a business plan that really outlines those 4 bullet points and how we're going to deal with them. So the attempt here was to study the space, look at us, look at others, give you that information, and then next come back with a plan. And with that, I'll turn it over to Michael and team. Michael and team.
Okay.
Michael and team. Sorry.
Well, like Mike DeRay Real Estate, also up here Greg Nyland with the real estate group, and Monica and Michael, who've been introduced. We did want to take a fresh look at an independent look, and Monica and her team did take a look at the industry, and she'll go through that. Townsend helped by giving kind of a history in real estate in there, and the staff helped in giving our history and working and explaining some of the types of things we do that might be different in our industry than other industries that Monica has looked at. So with that, I'll turn it over to Monica, and we're open to any questions throughout the presentation. We do have we gave some examples of some of the investments we did, and we do have a couple of our managers here, and we'll introduce them later in the presentation.
And before we start, I'm going to completely embarrass Monica, who's going to be upset with me, but it is her birthday today, so you have to be nice to her. Came yesterday. Oh, sorry. It came all the way to Sacramento just for her birthday. I'm glad we have nice weather.
It's
so.
great to be 25. Thank you very much. Well, thank you. Thank you, Chris. Thank you, Mike. And thank you for that. Happy birthday, Chris. Madam Chair and members of the board, thank you for the opportunity to present to you today our Real Estate Emerging Manager report and the study approach we followed, our findings, and our recommendations. So in terms of the study approach, we selected a wide variety of industry players and asked them to provide their thoughts and their experiences regarding the approaches to emerging manager programs, the opportunity set in the emerging manager space, and the state of diversity in the industry. And the whole goal, of course, was to learn from their experiences, understand best practices, to allow CalSTRS to further enhance its efforts in the emerging manager arena. And we also reviewed a wide variety of industry papers for context, and they're all listed in Appendix B, in Appendix 2 of our report, and they're also available on your website under Partner Resources. So in slide 5, you will see here who we interviewed. So a total of 44 industry players, a broad range and type of participants, including institutional investors, consultants, emerging and established managers, and other researchers and affinity groups. So in terms of study findings, in terms of program approaches, we basically found that there are 2 broad methods used by emerging manager programs. So one of them is when the plan or partners or directly enters into a relationship with the emerging manager or the operator in a one-to-one relationship. And the other has an intermediary, either in the form of a fund of funds or a manager of manager. And something that is interesting to share and note, as you know, is that CalSTRS has used all of these approaches in the past and has used them successfully.
I'm gonna pause a bit on this. It also is typical for the direct relationships to be done by larger institutions because they can afford to fund enough money to get the emerging manager in business. So if the emerging manager needs a 50 million or 100 million under management, it's more likely that a plan sponsor of size would have a direct relationship or a joint venture relationship with an emerging manager or an emerging operator. And that's why CalSTRS has been active in that marketplace along with other larger investors. Smaller investors that typically invest in funds, their options are more limited to a fund or manager of managers, although we have tried to participate in all.
Thank you, Mike. So on the next slide, you will see in terms of program best practices.
Oh, sorry.
Thank you. Oh, you're the one managing. Thank you. So we'd like to provide you with a quick review of the best practices we found when it comes to running an emerging manager program. And in fact, many of these best practices are reflected in the recommendations we're going to discuss later, such as the need to commit the right amount of resources, shaping the right manager evaluation process, the right governance structure, the right cycles. But a couple of points I'd like to highlight here are related to the manager review process that takes place prior to hiring. So the first point is ensuring that the requirements are tailored and respond to the space characteristics. So what we mean by that is that there have been times when requirements are set up that may eliminate many or all emerging managers from consideration. And the second point I'd like to highlight is the importance of communicating the criteria clearly to the manager participants. So this ensures that the program is well understood by potential participants, which promotes exposure to more talent, increased participation, and higher chances of program success. In other words, a thicker pipeline can bring better outcomes. Some managers pointed out, as we were conducting the research, that at times their process seemed unnecessary, elongated, or uncertain. And so communication and interaction, we believe, are key elements to better programs. In terms of the emerging opportunity set, our survey revealed a general consensus that there are less than 400 emerging managers and less than 500 emerging operators that comprise the emerging real estate universe. This, of course, doesn't mean that 100% of this universe is investable, viable, or appropriate for the needs of CalSTRS real estate strategy. But it is sort of the feedback we found from the different players of how, what the size of the current universe is.
Ms. Rentia, can I just ask, is that,
Please.
when you say that number, is that in the U.S. or is that?
U.S. Correct. So really, we were here exclusively surveying the U.S. emerging manager segment.
Okay,
Yes.
thanks.
So in terms of industry dynamics, we also heard from our survey participants that there is a general trend of asset consolidation in the industry, where a smaller group of established managers is managing a larger pool of assets. This consolidation may in fact create great potential for emerging managers and for larger returns for them, because they may focus on local expertise, specialized market strategies that now may become subscale for larger managers and therefore have fewer buyers and might become cheaper, and where there's a niche expertise that the smaller firm can seize. But a point to note is that these smaller local opportunities do need meaningful AUM commitments for the emerging managers to seize them and to give them the necessary scale to operate efficiently. Industry diversity. So that was one of the questions we asked the participants, and the study found that there is a general perception and an understanding that the industry does suffer from a lack of diversity. There are a number of suggestions from our survey participants that include support to and from affinity groups, as well as measuring and reporting diversity as a means of creating the conditions for change from within. To paraphrase, what gets measured gets done, and sunshine is the best disinfectant. So measuring and reporting internal diversity, investment program, and provider diversity do become an important part of the transformation process, as they will highlight the problems and create the impetus for change. And these are all areas where definitely going deeper and allocating more resources will bring increased diversity. Finally, with regard to recommendations, our recommendation is that CalSTRS continues to enhance its systematic approach with a more formal structure that incorporates the best practices we found, and we found them in particularly 4 areas with regard to emerging definition, program structure, evaluation metrics, and industry diversity. The 2 key elements with regard to program structure are the right size and the right governance. We believe that when it comes to real estate emerging manager programs, there is a big need for placements to have a scale that allows for efficient and cost-effective investments. And this leads us to conclude that capital placements should be around 50 million or more when it comes to fund of funds, and a direct around 100 million or more. And this size of placement requires the commitment of internal resources to analyze and monitor the managers and investments, and requires the right governance, the right governance and the right controls to protect the interests of CalSTRS and the plan participants. With regard to evaluation metrics, we believe it's important to recognize the long duration of the asset class, the cycles inherent to the asset class, and also the need to separate by strategy and by vintage when it comes to evaluating the success of these programs. And finally, with regard to industry diversity, no question, CalSTRS has had a very good history of being an advocate of industry diversity, and we believe it could and should continue to take that leadership role. And diversity is not just necessary at the manager level, but at all levels, within the plan and broadly within the industry. And CalSTRS can play a key role at all levels by measuring, reporting, and advocating for diversity.
And before we go on, it's really important that we agree on the emerging definition. That number has been danced around and used different numbers
Yes.
over time. I've seen it as low as 300 million, as high as 2 billion. But we have to pick a number, and the industry isn't consistent on it. Maybe Michael, you could talk about that, of how the industry has looked at emerging managers in the past.
Yeah, I think that, initially when emerging managers became a topic of discussion and specific criteria were created to allow them to participate competitively, the definition was, I think, 750 million. And so what's happened with the number is just the cost of running businesses. It's a guesstimate of what it really takes to run a business enterprise in the real estate asset class in order for a firm to be financially stable enough that you are being prudent in making an allocation to them. And so the number really isn't a very good hard number. We are, within our clients that have these mandates, it tends to be around 2 billion, but they are usually smaller clients, and so they need a larger manager that they want to be able to go over 1 billion in order to still help an emerging manager because they're going to be a small portion of their business. So the more you can give the manager, the smaller you can actually look at and allow them to participate and give them capital allocations. The $1 billion is, it's as good, as Mike said, it's as good as any other number until you start to see that it eliminates your universe of people you can work with, and then you have to work on the number.
And just maybe everybody's up to speed with that, but what we're talking about is the size of the investment manager, not the size of our commitment, but what's the assets under management of the investment manager. Okay.
Greg Nyland's staff, I'd like to follow on that thought for just a moment. That is also a number, the $1 billion number is also a number we use in our reports to the legislature, so it is kind of CalSTRS wide, some consistency there as well. We also measured our own portfolio, looked at the managers that we have, and we did 2 different runs. We did it at the $1 billion level and at the $2 billion level, and did we really miss much? And the delta between the 1 and the 2 billion was de minimis. We really didn't miss anything, so we elected to stay with that $1 billion number.
Follow-up question, and maybe Ms. Menti, you can address this question, because I hear the term emerging manager a lot at a lot of conferences I go to, and I noticed in your write-up, or yeah, in the report that we were given, that it talked about smaller, newer, and sometimes diverse. That language was used, and when I go to conferences and they talk about emerging managers, it almost always means diverse. I know that those other pieces are part of it, and I guess I'm just wondering if in the world that you work in, when people use that language, is it 1, 2, or all 3 of those? Or, you know what I mean? Because I think it's a little confusing, and just emerging, that language to me, especially around the diversity piece, is a little bit, I don't know, I wouldn't say a misnomer, but it doesn't seem to capture, I don't know what a better word is or a better descriptor, but I just wonder if you could speak to that a little bit.
Right, yes. So the clients we work with use a wide variety of definitions, and depending on the state where you're in, or the corporation, or the specific legal framework, you may find definitions that are very restrictive, where emerging actually only means women and minority-owned firms, like the case of Illinois, and the much broader perspective, which is the California perspective in the frame of Prop 209, where the definition of emerging involves this smaller, nimbler, inclusive of diversity, but it's a framework that I think adapts to your, constitutional framework. But it varies very much. We have insurance companies that are telling us we want to work with a certain size of managers. Others that say we want to work with especially women-owned firms because we have a desire. So I would say the word emerging today is very inclusive, and it can be a characteristic of size, evolution of business, or ownership, and it varies very much by the institutional investor that is doing their definition. And as Michaelin was saying, when it comes to size, some emerging definitions may go very wide. I mean, in our database, for example, with equities and fixed income, we go up to 10 billion, because we do have clients that say, for us, emerging can mean a $5 billion firm. Some others will go down to 500. So yeah.
Okay, because I was just wondering in that definition if you could be a newer firm but not be small and not be diverse and still fall in that, you know what I mean? That category, given the language that's in the
Right.
report.
So I would say, and Mike and Michaelin and Greg, correct me if I'm wrong, but I think that the California definition and the CalSTRS definition is a very broad definition where there is an interest to capture diversity, but there's an understanding of a constitutional framework that needs to be respected.
Got it. Did you want to
I just want to echo, we have absolutely found and agree that we have to have a clear and concise definition that we can use. But I want to be honest in that state of California, Monica outlined in INV 613, the state law she described and the issue we face. But then when we turn around and go to conferences or to the legislature, it's wink, wink, nudge, that's not what we mean. So it is hard because it depends on the eye of the beholder. I think all we can do is stick to our guideline and hold to it, and then we'll have to deal with people who will say that's not what it meant. But we know that from a fiduciary standpoint, ours, and Brian's looked at it, ours stands within, the law and the code.
So Chris, where is our definition, is that the definition on 613, or where is our definition? I'm just wondering.
Well, I think as you were hearing, our definition has been $1 billion and under. And it depends on each of the asset classes, but that's what, as Monica said, that has been our definition of it. It has just, I'm just saying it has come under attack because it is it's inclusive. It doesn't reference ethnicity or gender. It just deals with assets under management.
Okay, that's very
And I think the
helpful.
important point is that it broadens your net rather than narrows it.
Right.
So you can include people that are of diverse backgrounds, firms that have diversity as well as ownership by diversity in that under 1 billion much more easily than if you defined it by diversity. So it is as broad a net as you're going to get. And because of the structure of our industry, if you are a minority or women-owned firm, you are in likelihood a smaller firm that's just starting and doesn't have much assets under management because that's just the development of our industry.
To give you some additional context in how we're doing, of the $22.2 billion real estate portfolio as of the first quarter, 36% or 38.2% is with emerging managers. That's so 38% of our real estate portfolio is with emerging managers. That's about $8.5 billion of the current portfolio. We also extracted out our exposure to women and minority businesses, and we are 12.3% of the real estate exposure is with women and minority-owned managers. Not all of them are emerging managers because some of Mr. McFarlane is here. His company has emerged, so he no longer meets the billion-dollar criteria, but he does fall into what we were talking about in terms of that participation level.
Actually, I had a couple of things. It really makes me nervous. This is now the second time that I've heard investment folks interpreting the California Constitution. So my first advice and comment is stop it. The second is, this organization, this system, and this board stands for diversity, and there's no question about that. But sort of following up on a theme for the day, as fiduciaries, you are first is your duty to make prudent decisions. And so one of the things I would suggest to the board is that they task staff with demonstrating how diversity is of value to the portfolio. And I don't mean to be hard-nosed about this. I just think that that's an aspect to it. And I know we've had that in other discussions and we've talked about it, and I just think that it's an important point to keep out there because, this really is an important thing, and this board has, as long as I've been here, has stressed this issue. But I think the other part is, as you're taking steps, to remember that you need to sort of demonstrate what the long-term value is to moving in this direction.
I appreciate that. I hope staff all heard that because I actually do think that's a really important piece for us on the board and for CalSTRS, because I know even with the ESG, the environmental, social, and governance issues, when I go talk at places or, I think those ESG principles or emerging manager, those can tend to get marginalized at times and seen as sort of pet projects or token kinds of things. And I think, I would only speak for myself, but I think we consider that integral value of our fund. But at the end of the day, we are fiduciaries. And so we need to be thinking about those principles in light of, making money for teachers' retirement, but doing that in a way that reflects the values of our members. So I think that's a really critical part. And thank you for the reminder, Brian. Michael.
A couple of comments. One, I want to congratulate you on what looks to me like a very good program. I'm very happy with the way it's structured. I prefer the emerging manager structure with the dollar value criteria as opposed to the ethnic or gender based for a couple of different reasons. But most of all, I want to I think it's beneficial for a state like this one, and for the country, by the way, because there is so much diversity that using this criteria is going to pick up women and minorities, and for the simple reason that, and let me back up. Let's not forget why we're doing this in the first place. Let's not forget why there is a need for this. And the reason is that without this, there was an old boy network, and you didn't get in unless you were white men. So, you know, we can dance around all this other stuff, but this is the reason. And for that reason, it's easy to just say, we'll use a threshold number to identify other folks who want to pick them. Why do we want to do it? We want to do it because we need to be inclusive. And this is just kind of the obverse of what would normally happen if we just went with the criteria of, well, let's go with the person who did it before. Well, before, when it was done in an explicitly exclusionary fashion. And so you would get the same people over and over again. So we had to take extraordinary steps to say we are not going to look at the same people over and over again. And I also want to say one of the things that I like about this is that you did not describe this as a training program. This is not a situation where you're saying, let's teach people how to do this. No, this is just making sure that we open the door to people who otherwise would not get in because we set the bar so high. It would be very easy for this organization to say, we're only going to look at managers who have $100 billion under management. And hopefully we can find some women and minorities in that group. And you're not, and you say, oh, we tried. That's not going to work, and that's why we have this. And it is not, and I'm happy that it's not designed to focus on women and minorities. With a diverse population that we have, that the issue is it's giving an opportunity to people who otherwise didn't have an opportunity because they were explicitly excluded. So I applaud you for the way you're doing it. I applaud you for the focus. I applaud you for, and as Brian said, let's talk about two things. One, the extent to which their performance, number one, and you guys are holding them to the same performance standards that everybody else is being held to. And so let's talk about that in your report. Maybe you don't have that here, but in future reports. And also, I hope that you're keeping track of people who, as you say, graduate from the emerging manager status. Because quite frankly, that's the whole point, to make this, to use these resources that we have to make sure that the opportunity is open to everyone who is able to compete and help us achieve the goals that we're trying to achieve, so that there are no artificial barriers to entry or artificial barriers to success. So I'm very happy with every aspect of this program. We do not need to apologize or wink about, oh, we're trying to look for women and minorities. We're trying to look for people who have been excluded from the process. And everybody should we are given an opportunity for everybody to do that, because before that wasn't the case. So with that, I mean, I'm very happy to see what's happening. Please keep it up. Please keep monitoring it. And don't lose track of those people who graduate from this because they are so good and they're outperforming everybody else that, more money keeps flowing in. So with that, I'm looking forward to future reports about this.
If Sharon, actually, Monica has one last slide, and it talks about the implementation approach, and then it'd probably be appropriate.
Yes, and
let me piggyback on this. Just take a second. I look at this, Michael. It's not what we give, but what we get. Frankly, I think we get. I mean, look, I'm frequently aghast at the opportunities we get by being large, right? But I'm afraid sometimes we miss the opportunities we get by being a little smaller. And for me, the notion that we do something like this creates opportunities for us to make money in ways we hadn't thought about before, for the, for the benefit of our beneficiaries. So for me, it's not like this is a gift. This is like something we get. And so I'm very comfortable with the approach. This is, the more we broaden our horizons so that we're looking at things that we don't, like I say, and one of the advantages of being big is that, frankly, we have the opportunity to look at things that are maybe not as big. And so for me, the idea is that's what this is all about. There's more ways for us to benefit the people in the system. And for me, it's really easy. It's great that we have all these kinds of other things, because we're missing opportunities. There are opportunities out there in the world that, because of our size and because of the way we've always sort of done things, we get stuck. And one of the really lovely things about being involved with CalSTRS is the fact that we really have a great tradition of opening these things up in all kinds of areas to the advantage of our beneficiaries. So,
if I may point out, that's why we don't advocate one model. We do the joint venture models, manager-manager, fund-to-fund models, because we believe we want to have multiple touch points, so that we can capture larger emerging managers, and then some of the fund models will allow us to access smaller managers we wouldn't be able to do on our own.
I'm extremely pleased and grateful for all the comments you just made, and I do believe that the work we are doing has that spirit. And you will see in our closing slide that many of those elements are captured there. So thank you for those comments, and I do believe that board spirit is permeating into your advisors and your staff. As Greg was mentioning, CalSTRS has had success in following a number of approaches, using both intermediated investments and non-intermediated investments, like direct hires of managers and operators. And our recommendation is that CalSTRS continues using these complementary approaches that allows them to capture a wide variety of opportunities. We do need to recognize, and this is something that was discussed frequently as we put together the report, that there is an intensity of the staff and a cost of getting into these new territories where there's going to be a time allocation and a resources commitment that needs to be there in order to continue to explore the space, continue to measure, continue to evaluate. And I do believe that's one important takeaway. In terms of the opportunity and some of the comments that you made earlier, we believe that by adopting a formal emerging real estate program, CalSTRS can continue to exploit the opportunity that resides in the emerging manager space and fulfill its commitment to diversity, and at the same time meeting its fiduciary obligation to its plan participants. Diverse firms will provide diverse perspectives, which can lead to new and diversified opportunities and returns enhancements. There is a large degree of consensus in the industry about what are the best practices that need to be implemented. I think that the key element is then to say we will just continue to move forward in that direction, measuring, reporting. The key challenge is to continue to explore those opportunities that are frequently driven, as Mr. Sager mentioned, by changing demographics. One of the or a couple of statistics that I was very impressed by that we came to understand through the process is 53% of total new owner households in this country is Hispanic. 1.2 trillion purchasing power of a community that is growing at 100 billion every year. So clearly there's a significant overlapping between new opportunities, changing demographics, new territories, niche markets that CalSTRS has been exploring, continues to explore. One of the relationships that they have recently initiated, I believe Arturo's here, and Greg probably wants to introduce him.
Yes, I'd like to introduce three individuals that are my business partners, our business partners. First, Victor McFarlane. He is with McFarlane Partners. As I said, he is now emerged. Victor and I have been doing business together.
Balloons.
How long have you been doing business with him?
20-something years? How long is it? 20-plus years.
Rats, you got me beat.
Sitting next to him is Jair Lynch. Mr. Lynch is a Washington, D.C. based developer. He is within the manager of manager models in that he works with the McFarlane Fund, and McFarlane Fund works with the Lynch Company to oversee their projects in Washington, D.C. And then I'd like to introduce Arturo Snyder, who is the president, CEO of Prime Store in Los Angeles, which is a retail developer. It's our newest relationship. You just read about it. We closed that venture at the end of the year. It was a kind of a stage closing, but at the end of the year and into the first of this year, we've got some developments we're doing. We bought into an existing portfolio. We're excited about the possibilities going forward. And they are here to, if you have time, if you want to have questions, directly asking questions of emerging managers, what's worked for them, what hasn't worked for them. If you want to know how they like doing business with CalSTRS, they'll be glad to answer questions.
I think I'd be honest in here. I mean, really.
Happy to answer any questions.
I just had one follow-up question, which is I know about the New American Alliance, and I know there's a group of us in LA, pension trustees, that are trying to cultivate, emerging trustees, if you will, or diversity in trustees. And I just wondered if there's either in California or nationally, are there, groups that are trying to mentor and really give a place to kind of dialogue and encourage emerging managers? I mean, is there organizations, or does NAA do stuff, the New American Alliance? Do they?
So NAA has quite a comprehensive agenda because in addition to capital, they also have a philanthropy and education, human development agenda. There's a number of other organizations like TWIGO, like SEO, like NASP, like AIM, that are all in that same idea and mission to sort of develop a more inclusive investment management industry. And as you point out, it permeates through every level, right? You need trustees who are asking the right questions and come from the type of experiences that lead them to want to be involved in diversity efforts. You also want investment staff to have that diversity at the manager level, at the fund-to-fund level. Some of the clear challenges in the industry is nurturing that pipeline, right? That perhaps starts from kindergarten on, and it is a challenge because today, the last time we counted, and we've done many reports in the diversity of the industry, there's around 120 Hispanic-owned investment management firms. There's less than 500 African American, less than 500 Asian American. Think about the women's segment. It's also, I think it's a universe, when I think about it, that holds a tremendous amount of opportunity, but that we're still at a young stages, at an early stages. But I do believe that organizations like CalSTRS, in partnership, because CalSTRS can't really do this on an alone basis, but CalSTRS can play a key role in interacting with these affinity groups, with these organizations, and sort of developing those relationships so that, one of the things that, I was a board member for 12 years at NAA, some of the, very practical things is, what are the openings? So that there could be a list of people that once there is an opening, then we can say, here's a list of people that can fill that post. I think that all of those efforts are still, again, at very young ages. TWIGO, I thought talking with the chair, past chair Marcos, told him, how many kids have you guys graduated? Like 15, 20,000? He said, no, only 1,000. See, so still much to do ahead. But I think that, my perspective is that it's an incredibly promising area, fueled largely by changing demographics and market opportunities that are there to bring high growth, high returns. So there's an interesting market to seize.
And I would just add that it's particularly challenging in real estate, because real estate, unlike stocks or equities, public market equities or public fixed incomes, has a challenge in that the startup costs and the ability to run a firm is extremely expensive. And so we've found, even in our efforts to help the process, we work with the Emerging Manager Symposium that takes place once a year. And we've gone, and so about all we could do is fill a room with 7 managers who happen to do real estate, and we did what we call fireside chats, because it was just too small a group, to teach them how to, what you need to do to get to a consultant, how that process works. And so it's very difficult in the real, like when I go to those conferences, it's predominantly stock and bond people. It's not very present in the real estate area. So it's getting there, but there's a startup cost that's pretty significant.
I attend 1 or 2 conferences a year that are emerging manager conferences specifically focused on real estate. So there's not a lot, there's more coming on. But it's sit on a panel, and it's generally the plan sponsors and folks asking, how do we access you? How do we do business? So it's trying to explain to them, yes, we're open for business. CalSTRS can't do everything. CalPERS can't do everything. You need to approach some of our peers as well. But here's how you access an institutional, here's what's going to work, here's not what's going to work. Trying to encourage folks about how to access folks like us. And so we are participating, and we will do more as well.
Chris, did you want to jump in, or?
Yeah, just to wrap up the next steps in the process. Like I said, real estate staff is going to come back to you with an implementation plan based on this model. I'm going to ask them, since they brought up the issue of staffing, to include a resource plan so that you're at least aware of that and can make that financial decision. To Michael's question about performance is always measured by the consultants in the semi-annual report, so I'll ask Michael to start creating an emerging manager breakout, just like Mike Moy does, so you can see what that is. We can do the same thing in global equity. I think that's a good point. We don't do that for Alan in his report, but you do see the performance coming through in those reports. You also get a diversity report every year in February. That's now a law starting next year by the legislature, a requirement, but we started a year ahead of time. You got one last February meeting, but every February you'll get a report from us that will be going to legislature on the diversity within the investments across all the portfolios. So it'll break out every asset class and show the emerging manager program by asset class.
I hope someday we don't have to talk about emerging and diversity. I hope it's just, I go to Milken and I look at these panels and there's lots of women and, because I'm getting ready to go to Milken with a couple of us. And I remember last year, every session I went, I know there's a lot of white males in here and I love white males, but there were a lot of them at Milken. And it was striking. Even just as a woman, there were not a lot of women on these panels. And so in our day and age, especially, this is something that happens in Los Angeles. I was just struck by that in the financial industry. So I'm hoping that someday we don't even have to make it a big deal. That'll just be commonplace in the industry. So thanks so much for taking the time to come. It's nice to have you there, and thanks so much, Monica. All right. Item 18, Deborah Smith. We've got mid-year report on investment costs and cost effectiveness. A few more items. We're winding down.
Yeah. I want to bring up Deborah Smith and her staff, Melissa. This is a report that we've been putting together for a number of years. We're changing it this year, which I think is important going forward. It used to be focused on budgets and costs. Now that information will be picked up in the Business Direct reports. So we're going to focus more traditionally on cost and cost effectiveness, which is the CEM, used to be Cost Effective Measurement Service. They do come to you every other year at your request. They can come annually if you want, but they come every other year, usually in the fall, and give you a comparison of our cost relative to all of our peers. So with that, did I just steal everything, Deborah?
Almost.
Uh-oh.
That's all right. Thank you. Yeah, this is Melissa Duranco. She is a member of my ops leadership team. Yes. I'll bring it closer. She's a member of my ops leadership team. She does a lot of analysis and data gathering for the cost-effective measurement, or the CEM survey. She was very instrumental in helping put together this agenda item. This item, like Chris mentioned, is our annual information item to provide an overview of the costs associated with managing the investment portfolio. As you know, costs are a constant drag on the portfolio, so we watch them very closely. There's 3 key takeaways this year that I want to bring to your attention is that we're very cost efficient relative to our U.S. peers. We run our internal portfolios cheaper than our U.S. peers, and we're also under budget. So if you would turn with me to IMV page 652, you'll see a chart, and this is actually from CEM. It shows CalSTRS total costs versus our peers. Keep in mind, this data is calendar year data as of 2011. We're currently working on the CEM survey for 2012. So if you look at the green line, that represents the average peers, and this is in basis points, this cost. So you can see that our average peers are averaging about 54.7 basis points, where the red dot represents where CalSTRS is at 49.1 basis points. That equates to about $715 million of cost. The other 2 items on that chart is just a breakout of the total cost in investment management and oversight and custodial cost. The second item I wanted to bring to your attention is we run our internal portfolios a lot cheaper than our U.S. peers. We run them $11 million cheaper. Even though our U.S. peers manage more assets in-house than we do, they manage 50%. We're currently at 36%, but that will change as we continue to implement the internal-external management plan. And the last thing I wanted to share with you is that we're under budget, and that is denoted on page IMV 654. So do you have any questions?
Oh, I don't know if I can do that. I can just speak into this, Mike. Sharon had to leave, so she asked me to call on people. Let me grab her mouse. Paul, you're up.
Thank you. Yeah, I just want a clarification because I think in our board packet on page INV 653, I think, are the arrows going the wrong way?
Yes, they are.
Okay, thank you.
That was corrected on the website.
Okay, thank you.
You're welcome.
Anybody else?
Thanks, Tina.
You're welcome.
Hi, sorry. That was so quick.
She thought she had longer.
I was just gonna say, I needed some caffeine, so are we all done? Are we done?
Yeah.
Is that it?
Nobody else has any
All right,
comments?
no more questions. All right, thanks so
Thank
much.
you.
Thank you.
Thanks, Melissa.
everyone.
Thanks, Deborah. That's a lot of
Great.
work for a
No,
very
I
short
shouldn't leave.
presentation. Thank you.
Great. All right, we are on item 19, which is our review of information. So where are we at? Did you keep track of this group?
Well, I think to the extent that you have your report from PCA coming back on the draft agenda, I don't know if you necessarily want to isolate any of that as an information request specifically. It's up to you.
Sure, 'cause it's really a carryover from
Yeah.
today's meeting.
I think that was it.
Okay. All right, item 20 is the draft agenda for our next investment committee. Is there anything that we need to add or amend to that? Sure. We've got Neil, Alan. Yep, Chris.
Yeah, just for Brian's sake, I wanted to cite the California Constitution one more time. No.
He's kidding.
I'm kidding. So, in reflection of the Virginia State Constitution, depending on how your June meetings plan out, I know this was a very long day. I thank you for your patience and your energy. Depending on how that plans out, I'm going to assume a lot of time for item 5, the last step in the asset allocation, so you have plenty of time for that. But we may have a transaction, which always adds an hour, but we will see if we can put together a panel on active and passive management. One of our fund of funds managers in the equity space, a minority firm, put out a very recent piece, an excellent piece, promoting active management, and then we could bring in somebody who's a fan of passive management, so that way we'd be able to start that discussion a little bit earlier.
Great. great. Obviously, I assume you'll talk with Harry when he's feeling better, and you guys can. And I have to say, I did write a note to Dana saying I miss hearing from corporate governance. So I'm excited that we have a corporate governance update on our next agenda. So look forward to that. All right. Any others? All right. And then opportunities for statements from the public. Anybody in the public want to make a statement? With that, I think we are adjourned. Yay. There it is. Thank you.